Hey everyone, it is Thursday, April 16th. Thanks for bearing with us. I'm Deirdre Bossett, and this is another CNBC live stream. Okay, so this week, the AI models, they got better once again. The competitive picture keeps shifting, and we are now 2 weeks out from the biggest single day of earnings season. Meta, Microsoft, Alphabet, Amazon, they're all on April 22nd. And just this morning, Anthropic shipped a new model, Claude Opus 4.7, the best publicly available coding model on the market. And here we are once again, another week leading with this company because Anthropic is having one of those years where every quarter they do something that just changes the conversation all over again. Now look at this data. SimilarWeb, it tracks traffic share across AI products. A year ago, ChatGPT had 77%. Today, 57%, lost 20 points in 12 months. And the market is still growing the whole time. So OpenAI, yes, it's getting bigger. They're just not the only game anymore. Gemini went from 6% to 25%, which is the number that should make people pay attention heading into Alphabet earnings. And Claude from Anthropic nearly tripled in 3 months, crossing the 6% threshold in March. That was before today's model. Now look at the calendar. Meta, Microsoft, Alphabet, Amazon, they all report on the same day, as I said, April 29th. Circle that one in your calendar. That is 4 companies spending a combined $650 billion on AI infrastructure this year, all facing analysts on the same afternoon. And this is the quarter where the questions get harder. What is Gemini's share growth actually worth inside of Alphabet? What does Microsoft get from hosting Anthropic on Azure while also running Copilot? And remember, of course, the early partnership with OpenAI still there. Does Meta's new model, Spark, change their thesis, or is it all still about the ads business and giving it new AI powers? And then there's the risk side. This past week, as the banks kicked off earnings season, Jamie Dimon and David Solomon, they both named a specific AI model on their earnings calls as a threat to their businesses. So corporate America, it's not just buying AI anymore. It is starting to reckon with what AI costs them to absorb, to secure, and to keep up with. Cisco's Jeetu Patel, he's up first. Then Jeff Richards is going to join us to break down what to watch when all 4 of these companies report in 2 weeks. Jeetu, thank you for having us in person.
So good to see you.
I'm so glad we finally did this. Okay,
I know.
Where should we start? I know today we had another model release. The market, it's funny, I said this, I remember last year when Google put out Gemini 3. I said the market doesn't actually care about model releases anymore. It really cared about that one. Doesn't feel like it's making a huge splash today, but maybe that's because they called it less capable than Mythos Preview, which isn't exactly like a glowing start.
Well, I think like the market does care about model releases when there's a step function improvement. And also in coding, it makes a huge difference for having incremental productivity. So 4.7 is going to be very welcome. You know, I've had pings from my engineers. They're all really excited about trying out the model and using the model. So I think there's going to be a level of enthusiasm. It's going to be better at going out and following instructions. It's got better multimodal capability. It's better at memory management. There's going to be a bunch of things it does well.
That's like benchmark stuff, right?
Right, but I do feel like if you take a step back and say these models are going to keep getting better and better and better. What are the macro things that are happening in the market that are structural shifts that we should be paying attention to is probably the more germane question to actually kind of focus on. And so if I were to think about it, we are moving from chatbots to agents, and these agents are like digital coworkers. They're not going to be like tools. They're actually going to augment our workforce, and the configuration of your teams is going to fundamentally change as you have these agents augmented the workforce. Now, what's important in this world of agents? Number one, agent quality really matters. How does an agent actually behave will really matter because that's the quality of the output that the agent's going to deliver. That requires a level of observability that we've actually haven't had in the past that we need to think about. Agent security with what's happening with Mythos, and you've talked a lot about this, is going to be really important. And the time that it takes for an exploit from the time that a vulnerability comes out is now a matter of hours, maybe minutes.
Right.
That actually changes the entire calculus of how you start thinking about adversaries and the way that they actually do attacks and how cyber defense needs to work. All these things need to happen at machine scale. Human scale is no longer sufficient. And then I think there's going to be a whole bunch of things that you need to do around productivity, how the workforce actually gets configured. So I think there's going to be a fair amount of these structural changes that we're going through all at once.
Right.
And it's on one end, it's exciting for people like you and me who are curious and like to geek out. But on the other end, it's also a little unsettling for people, because what happens to the job that I've been used to for a while that's going to fundamentally get changed? Do I need to get AI fluent in a hurry? What happens if I'm not AI fluent? What are the implications of that? I think all of these things we need to make sure that we think about deeply.
I like how you kind of step back and look at like the structural shift, right? Because there's a model out, it feels like every few weeks now. And when we talk about leaderboards, you can game them now, right?
Yeah.
And benchmarks. That's what a lot of folks are talking about now. So there felt like, there was this huge inflection point.
You don't even know, by the way, if you're actively gaming them. The models are smart enough
Right.
that they're starting to game it without you even knowing. And so like the way that you get the results in the real world compared to in the evals can be night and day different.
Right. And it felt like, so when you think about these big inflection points, it feels like one happened late last year, early this year for me personally, when exactly like you said, it went from chatbot to agent. Or you went from like a chatbot to a co-work or vibe coding or whatever it is. Is Mythos another one of those moments where like we just see this huge capability and we don't even really know the implications yet?
Firstly, I give Anthropic a lot of credit in the way that they've gone about and approached this thing. I think what Dario has done in this particular instance is a very smart way to do it.
On the safety side?
On the safety and the alignment side, because you don't want to have this model out in the wild before you've actually made sure that you've got critical infrastructure that's protected. So if you think about what it does, the ability for it to go out and detect vulnerabilities and then be able to exploit those vulnerabilities has now gotten to be at machine speed. And this has meaningful consequences on society at large. And if you start thinking about what this is the first time. So historically, if you look at the cybersecurity market, the adversary, which is the bad folks, always had the advantage. Why? Because they had to be right once, you had to be right every single time. This might be the first time that you could actually turn the tables a little bit, because if we have a little bit of a lead time and we can make sure that we actually get ready, you might be able to be farther ahead of the adversaries. And speed for sustained durations of time actually really matter in AI. I think that's one of the critical moats in AI. So I do feel like that'll be a really interesting piece, but I think Mythos is and what they're doing with Glasswing, I really, really feel is something that needs to be applauded. And I think OpenAI is coming out and doing something similar as well. And you will start to see this kind of extreme obsession on making sure that we can get our security posture as a society improved is going to be very important.
What do you make of some of the skeptics or critics, though, who say that safety was really convenient and Anthropic has approached compute capacity differently than, say, an OpenAI, which was like as much as possible as we can get? There's some that say that they actually couldn't release Mythos because they don't have the compute power necessary. And it's great PR. I mean, it is, and we've seen Anthropic do this a number of times, say something like, or it's so powerful that we can't release it, or we're obsessed with safety. It shows enterprises, right? And they're first an enterprise provider company. What do you make of that argument?
So firstly, I don't think those are in conflict with one another. You could be concerned about safety and security and also be constrained on compute resources. And those aren't mutually exclusive conditions. Like both of them can hold true. And yes, they might, forget Mythos. If you use CloudWorks right now, and if you try to go out and create a PowerPoint or a Word document, or Claude Code, there are times when this thing will crap out. Why? Because it doesn't have enough capacity for the amount of influx that you're getting of the traffic usage. In this day and age, that's actually a good thing. That means that you've actually got intrinsic demand for your product, right? And so I don't think it's a PR stint. I think what it is, in my opinion, is you've got a very potent model. They want to be careful of how they roll it out. I think we as a society are going to have to actually start thinking about this, and the sequence of rollout will really matter. And you will be compute constrained at the same time. And those conditions are going to hold true at the same time.
There's some very interesting things happening at the moment. One, you're hearing a lot more about compute constraints. The other side of it is costs feel like they're a little bit out of control. Jasmine and I have been looking at companies' budgets, and I think it was the Uber CTO that told the information. I'm sure you saw that, right? That they blew through their 2026 AI budget. Goldman Sachs had a note that said that it's actually approaching the cost of actual human engineers. How do you think enterprises are going to deal with this? Do these like constant barrage of new models, especially at the frontier, make AI more expensive? At what point do companies say, like, forget it, we're going to look to different, more efficient models, or does that come out of different budgets?
So a lot of questions. Let's parse this out. Firstly, I think cost will be an issue, and tokens aren't free. AI isn't free. I always tell our CFO, you're going to get a lot of benefit from AI, but the cost of tokens is going to go up.
But we've been trained to think that it's kind of unlimited.
It's
These
unlimited
plans, even enterprises have
That's
that.
right. And so I do feel like there's an actual real cost to it. So if I were to think about what are the moats that organizations are going to have. So let's assume for a moment that coding is a solved problem at this point. And why is that consequential? Because the speed and the exponential curve is almost going to be like a vertical line. It's going to move really fast. Claude Code builds Claude Code, Codex builds Codex, Gemini builds Gemini. And so there's a snowball effect over here. As that happens, what are the moats that an organization is going to have? Because software is going to be easy to build. When you can build anything, what you choose not to build is actually going to be more important, because there's going to be a lot of AI slop. But what are the moats? What are the ways that enterprises are going to differentiate themselves? I'll give you three. I have 9. I don't think I have time to go through 9, but I'll give you 3. The first one is operating at extreme speed for a long duration of time so that you come early to market as a matter of habit is going to be a moat that every company should really start thinking about. So that's one, is operate at extreme speed for long durations of time. Number 2 is trusted delegation to agents will be a moat, because the difference between delegation to agents versus trusted delegation is the difference between bankruptcy and market leadership, in my mind.
And you're saying trust to delegation.
I need to trust the agent that the job I'm giving the agent to do, it's going to be able to do it in the way that I expect it to do it, and in not a different way. And that I have to have enough guardrails in place, and I have to have enough confidence that this agent's not going to go out and start taking my bank account number and debiting all of my bank balance. So that's number 2. And number 3 is tokenomics will really matter. Your ability, every country and every company's ability to generate securely and efficiently generate tokens is going to be a huge force multiplier. So why do I think...
Is that infrastructure and compute capacity? Data
it's
centers,
more than infrastructure and compute capacities. What kind of outcome can you generate from the tokens that you have, and how effectively are you able to go out and consume tokens on tokens per dollar per watt really matter, right? And so
that's efficiency then too. It's not just wastage.
It's security and it's efficiency. Secure generation of tokens in an efficient manner will really matter, and that'll become one of the moats of companies. So now let's go back to all engineers are starting to use a lot of tokens. Well, the thing that's going to be important is initially, Kevin Wheels on our board, and I was talking to him one time, and he's like, Jeetu, you have to keep in mind that the first time an engineer uses these tools, they aren't great at it.
Right.
They get better over time. And so what you have to do in the first phase is you have to let people know that you have unlimited use of tokens, just make it a habit and just start getting really good at it. That's phase 1. Mm-hmm. Phase 2 is then you start thinking about what kind of outcomes do you want to generate from this use of tokens that you have. And phase 3 is that outcome going to be efficiently generated. We are right now still between phase 1 and phase 2 in most companies, but you're very quickly maturing to phase 3 because you'll run out of cash to go out and do all the things. So just like you have a constraint on the number of people you have within your organization to go out and do something, you will have a constraint on the number of tokens you have to go out and do something as well. Those will be constrained resources.
What does that mean for the demand picture then? If we're at this between phase 1 and phase 2 and you give your engineers or your workforce unlimited tokens, we talked about token maxing a lot last week. Are we getting an accurate demand picture right now?
No, because I think what you need is you need to first make it a form of habit so that people get dexterous with the use of this stuff. Once you get dexterous, then you get efficient. But you never get to be efficient before you get dexterous. It doesn't make any sense.
It reminds me of what Ali Ghodsi told me last week. We were at a panel at HumanX, and he said, when we first had computers, people were still typing things up on the typewriter and then bringing it over to a computer, and there's just this habit forming.
There's a habit forming phase that you have to go through, and you have to allow enough time and enough oxygen for those habits to form. By the way, we made this mistake. We have right now, we've got our first product that is 100% written with AI. By the end of the year, we think we'll have a half a dozen products at Cisco that will be 100% written with AI. By the end of next year, we think 70% of all of our products will be 100% written in AI. No human lines of code. But when we first started, what I had done was I had actually restricted the amount of use because I'm like, well, I don't have enough tokens. I don't want people to go out and spend the tokens and not actually get good output from it. And then 3 months later, we realized that's probably the bad strategy to go out and implement. So what you needed to do was get everyone to just start using it so that they could start to get a feel for it. Once they get an instinct for it, it becomes a whole lot easier to get good at it. But the goal is get familiar, then get good, then get efficient.
What do you tell your CFO in that case?
We got to get familiar first.
So
actually, we're past that phase now.
it.
We're past that phase because our team is now at a very, very different clock speed.
Right.
But it was initially there was a level of concern on what's going to happen.
Right, and how much is it going to cost?
Yeah, and it's his job to maintain, not run out of cash.
Last question. We've already gone 20 minutes. We could talk for an hour. I know,
Has
very
it been 20
easily.
minutes
It's
already?
been. I know it's gone by fast, and there's some really good questions in here too. Jazz and I have been looking at this open router data that shows that a year ago, Frontier models made up like 40% of token usage. Now it's about 10%. And smaller models, more efficient models, I know that you guys at Cisco are doing the same thing. What does that ultimately mean for like enterprises? Because we've talked before and said most enterprises, they only want to use OpenAI or Anthropic given to them through Amazon or whatever it is, or Gemini. Do you think that that's changing? Do you think they're getting comfortable bringing models in-house, fine-tuning them themselves, smaller ones, maybe Chinese models that are open source?
See, the way I think about this is I think there's going to be an intelligent routing layer. And that intelligent routing layer will allow you to make sure that based on the quality of the prompt and the questions you ask, it'll get you to the right model that's going to be the most efficient and most accurate for the complexity of the question. So for example, I don't go to my CEO to ask him about where I should order lunch, right? My executive assistant's great at doing that. I don't need to take the TPU cycles of a CEO on that one. And it's the same in this case, is you're going to need to make sure that you have this intelligent routing layer. Most people will want to optimize for cost. They don't need to go to a trillion parameter model, go out and do something basic. And so what they'll do is they'll intelligently route the questions that can be answered by a small model, sometimes an open source model, because that makes sense. And then for other questions, you might need to have the horsepower of a trillion parameter model or a 10 trillion parameter model over time that you'll go to. So I do feel like it's all going to be dependent on the quality or response that you need, and that's going to be that routing layer that every organization is going to build out.
That's what Eric Lyman of Ramp told us last week too. That you
but
need
by the way,
sort of like
Cursor
a
had done
buffet
that.
of models,
Yeah.
right? What are you using personally right now? Everything, or like is there?
I
something
try to
you're
use
depending
everything
on?
because I feel like right now we're too early in the cycle to go out and lock into one, and you do get different things from different kind of models. So I do try to make sure that I spread my love.
Fair enough. G2, always great to have you. Thank you so much for joining us.
It's
We're going to
such a
get into
pleasure.
another interview, but thank you for coming by, and we'll hope to do this again soon.
I'd love to. Take care.
Okay, that was sort of the AI picture at large. Let's now talk about what to actually watch on that April 29th date I keep talking about, when 4 megacaps at the center of the AI trade, they all report. Jeff Richards is managing partner at Notable Capital. He is the right person, the exact right person to walk us through this. Jeff, welcome. For our audience, it's a green screen, yes. He has many great backgrounds, but we couldn't figure it out this time.
I'm a pro on Zoom, but I couldn't add it here, so you're going to get the green screen.
Right, when you go from different platforms. But we're just, we're here for your insights, Jeff, so it's great. I want to start with what you tweeted, I think yesterday, and it's really like sums up the earnings picture that we're about to walk into for big tech. UBS forecasts 17% earnings growth for the S&P 500 in the first quarter, the highest in 5 years. Morgan Stanley, companies are increasingly quantifying the benefits from AI adoption. Are we seeing the ROI that everyone's sort of been waiting for, and has that what's been kind of powering the AI trade most recently?
Yeah, I mean, look, if you look at that chart, it's been going steadily up into the right now for over a year. I honestly, I think many of us in Silicon Valley are sort of wondering why there's still so much skepticism about the value or the impact of AI. It's here. You have a large percentage of Fortune 1000 companies saying that it is making an impact on their organization. I think there are a lot of industries where it's still early: healthcare, probably government, probably retail, logistics, some of these other categories. Obviously, tech and finance are probably the early adopters, as they are in with most new technologies. But the other thing that folks, in the public markets aren't seeing is just the astonishing revenue growth that all of us are seeing. And Anthropic came out a week ago or so and announced that they had hit a $30 billion run rate. And I think you have to kind of put that in perspective. So Anthropic was at $1 billion run rate in January of 25. They were at a $9 billion run rate at the end of 25. And they're at 30 billion now. So they've added 29 billion of new run rate revenue to the business in the last 15 months. And just to put that in perspective, IGV, which is the software ETF that a lot of folks track and look at to sort of reflect the overall health of the software industry, the entire composite of that ETF added 60 billion of new revenue last year, and 30 billion of that was Microsoft. So think about 4 billion of new revenue for Oracle, 3 billion of new revenue for Salesforce, 2 billion for Intuit, 2 billion for Adobe, 2 billion for ServiceNow. So the kind of numbers that Anthropic is putting up are just astonishing. And what it tells you is the size of the IT market is getting bigger. It's not getting smaller. AI is not shrinking the amount of spend that companies are going to be devoting to technology. But a lot of that, if not the majority or all of it, is being captured by private AI companies. It's not just Anthropic and OpenAI. It's Vercel, it's Databricks, it's FAL, it's Harvey, Legora. There are all these companies that are raising capital from the private markets. And what we saw with the launch of Anthropic's new platform in January, which obviously took the world by storm, was all those businesses accelerated. They were growing quickly, and their growth accelerated in Q1. So obviously, Deirdre, I'd love to see some of these companies go public. I think it'd be good for our economy. I think it'd be good for the market. But until they do, so much of that data and so much of that intel is sitting with investors in the private markets.
Right, and that's why I always love talking to you, Jeff, because you see the private side, but I know you've always got your eye on the public side too. You can relate sort of the private software game to the public one. But are you saying that we're seeing this like across the board because Anthropic is growing so quickly? You're saying that the public software trade can grow quickly as well, because those two things seem in conflict with each other, and that's certainly how the market is acting. Forget like the revenue growth numbers. The market is telling us that they're extremely skeptical that SaaS, traditional SaaS, can even survive this kind of growth from Anthropic and other AI native companies, software companies too.
Yeah, I mean, clearly what the public market is saying is that they're skeptical of those traditional SaaS companies' ability to be a player in this market in 3 to 5 years. I think those cash flows will be predictable for a while. They have long-term contracts. They have a lot of embedded positions in the software stack of large Fortune 500 companies. It'll take time for them to rotate off of those. But they're doubtful that they're going to be a leading player in 3 to 5 years. And I don't think they're wrong. I mean, a lot of those companies got caught flat-footed. They don't have products that really tie into the growth of OpenAI and Anthropic. They're sort of trying to maintain, it's the classic innovator's dilemma. They're trying to maintain their legacy business while also launching new AI features and products, but they're not really going all in on AI like these native AI companies are. And there's a very popular notion in Silicon Valley, which is a question that we always ask when we're making an investment. Are you in the token path? So as the models get better, and they're going to increasingly get better and better and better at a very rapid pace, does your business get better? Does your product get better? Does your customer's experience get better? And I think what you see with most of the legacy software companies is that answer isn't really yes. And so they're going to have to come out with new products and services that get into that token path. But it's also going to cause some challenges for them because it also requires a different pricing model. Most of these AI companies are charging on a consumption pricing model, not a seat-based model or an annual contract model. So there's a lot of disruption coming for those big companies. One of the analogies I gave a founder the other day was, imagine, I'm a golfer. If on the PGA Tour, 120 players started a golf tournament 5 years ago, 60 made the cut and all 60 got paid. And I think what's going to happen going forward is more of the earnings are going to go to the top companies. So instead of 120 playing and 60 making the cut and 60 getting paid, you're going to have 120 play and 10 are going to get paid.
Right.
You're seeing that right now with all that revenue aggregation going to Anthropic and OpenAI.
That's a pretty scary ratio if you're a public SaaS company.
It's scary unless you're one of the 10.
For sure. So if you're an investor on that call, what are you hoping the analysts ask? Like, what is the perfect question an analyst can ask to reveal whether that company's on the token path, as you call it?
Well, one question would be, have you launched any new products which are directly tied to token consumption? And how is that pricing model related to token consumption? Because the big challenge, if you're a seat-based software provider, is you've got a model that was based on employee headcount and user headcount. It
Right.
doesn't, those employees could be consuming a massive amount. It could be consuming 10 times the amount of tokens they were a year ago, but you're still charging the same amount for your software. And increasingly, as companies look to build more internally using these models, they are moving functions off of that seat-based and annual license-based software and more towards this consumption-based model. So the other question to ask is just, if you're charging, an X amount per year for your software, what does the future of your business look like in a consumption pricing model? And a lot of those companies don't know the answer to that yet. But one of the reasons they aren't sort of publicly talking about that is A, they don't know, and B, it's probably lower than what they're charging today. So
Right.
consumption of technology is going way up. I think Fortune 1000 companies will be spending more on technology in 3 to 5 years than they are today, particularly in areas like cybersecurity and AI. But it's going to shift from that legacy model of seat-based and annual contracts more towards a consumption model.
So I was just talking to Jeetu Patel from Cisco about this. There was that story this week from the information about the Uber CTO who said that he blew through, this 2026 AI budget. There's been some research out from Goldman Sachs that AI, especially as we move to, especially as the companies themselves, like in Anthropic, move from these unlimited plans to charging by token consumption, costs are going way up for their customers. Where are enterprises going to make that up? Like, does the Uber CTO say, we're done, our AI spend for the year, so we can't do any more? Or are they going to say, we're going to cut back on legacy software to pay for this?
Well, I think what you're going to see, and this is a little bit what I was trying to highlight with my tweet yesterday, is the net. So here's an analogy. The net profit margin of the S&P 500 was basically flat for 20 years. And then from 1995 to 2020, it went up 7 points, obviously coinciding with the introduction of the internet. If we believe AI can have a similar impact and add another 7 points of margin, or 5 or 10, we don't really know what that's going to be, but I bet it will be at least 7, if not 10, and it will happen at a much more rapid pace. So in the next 5 to 10 years. So theoretically, if you have a more profitable business, you now have extra dollars to allocate towards technology spending. I think the other misnomer, and this is something I've been quite vocal about on Twitter, is I don't think the overall employment picture in America will shift, just like we shifted from people who were, doing farming and replaced with tractors, or switchboard operators who all of those jobs were automated. Those jobs that people have been doing will be switching to new jobs, and probably the best indicator is software developers. Everybody predicted, oh my gosh, with the rise of AI, we're going to have, it's going to destroy the market for software developers. Well, you've seen the opposite of that. In the last 18 months, the number of software developers being hired in job listings has gone up. So that if you buy the notion that software development is the first category that has really had heavy penetration with AI, and it is obviously with things like Cursor and others, and it then moves into marketing and sales and finance and all these other functions, and moves into other industries, we can expect to perhaps see the same thing. So which is a very positive labor picture. And back to your question, increased margins drives and helps fund some of that increased spending on some of these new technologies.
At the same time, when we saw the whole internet shift and better profitability follow that, it was all new companies, right? You had new massive mega caps come into the market. And I mean, now they make up pretty much the whole market. How do we know that it's not going to be this new class of AI company coming in, or space company coming in, like a SpaceX or an Anthropic or an OpenAI, that are going to go public, that are going to capture all of that? Like, could there be new leadership, and what happens to the rest?
Well, look, this is the classic. For those who haven't read it, I highly recommend reading Clayton Christensen's book, The Innovator's Dilemma, because it encapsulates everything we're talking about with the public companies trying to figure out their product roadmap to be in the token path, as well as obviously what we saw, with the rise of Amazon and Google and Facebook and all these other companies. That is going to happen. And I think it's one of the reasons why you see, if you look at venture capital last year, or the notion of venture capital, but really just private capital into private companies, was a record year, $250 billion invested in private companies. We then, $250 billion invested in private companies in Q1 of this year alone. Now, a lot of that went to OpenAI, about half of it. But it just tells you that large capital allocators around the world have figured out that all of the growth and all of the net new spend is going to be in these rapidly growing private companies. They're reallocating budget from their small, mid-cap, even large-cap technology allocation and moving it towards these private companies, which is why Anthropic and OpenAI and others have not had any problem raising capital. I think the second thing you'll see happen this year, we had a record year for M&A. Last year was the largest year for tech M&A since 2021, and other than that was the largest year in history. I think that will continue this year. I think eventually some of these large public technology companies are going to realize that they are way behind in AI, and they're going to have to reach into their pocketbook and acquire some of these up and coming private companies. The challenge is the value of those private companies looks very extreme, particularly when you compare it to the public companies, which have seen their multiples compressed down to 3 or 4 or 5 times revenue. But they don't have the team, they don't have the DNA, and they don't have the capability to actually create the products they need to create. And so at some point, I think you'll see them reach out and try to acquire some of these companies.
Right. What does Megacap have to show this earnings season, specifically on April 29th, when they're all reporting apparently at the same time, the 4 big ones at least? Really good week, right? We've been talking about how the AI trade has been kind of going sideways for the last 6 months or even more, but like this week alone, you've got Microsoft up 13%, Meta 7%, Nvidia 5%, Google 6%. The trade feels like it's back on. What do they have to show investors in the weeks ahead to kind of keep that rebound going?
Well, they've all been posting great numbers. I mean, you look at the
that's right.
trade
The market
down.
just hasn't been buying.
Yeah, I mean, the trade down over the last 90 days really didn't make any sense based on fundamentals of the companies. It was probably just more to do with geopolitics and uncertainty. I think it's hard for us, as you know, as venture capitalists, we're very long-term investors. We're investing over most times a 7, 10, even 15-year period with these companies. And so we're thinking very long-term about where things are going directionally. I would have a very hard time listening to anybody who argues that this AI tailwind is not going to be an investable trend for the next 5 to 10 years. And so if you believe that, then you're just having to go along for the ride with the volatility, whether it was the Liberation Day back in April, you had the volatility with Iran in Q1 of this year. But the market, as you saw in the last week or two, seems to be sort of shrugging those things off. I just, the long-term fundamentals, I mean, you look at UBS's forecast for S&P earnings, these companies have continued to deliver. NVIDIA keeps, amazing people with the growth that it's doing at the scale that it's doing it. And I can tell you from our universe, the companies that we work with, it's never been harder to get NVIDIA's GPUs.
Right.
And we just had Blackwell come out. So there's just so many good things to like. And I think what you're seeing in trading in these names in the public markets is more to do with just uncertainty and geopolitics than it does around the fundamentals of the business.
Sometimes the simplest answer is the one that is right in front of you and actually driving it. I know, I feel like we've spent the last 6 months talking about why is the AI trade stalled, and it may just be the macro. We're seeing it take off, certainly. So, Jeff, always great to get your insights, especially ahead of earnings season. We will certainly check back in with you once we're through it. Thanks a lot for joining, especially last minute with the green screen. Thank you, Jeff. We'll get it sorted next time. Appreciate it. Thank you, everyone, for watching. Great guests this week. We'll see you next week. Thank you to Robert and Evan behind the camera, to Sammy in the director's room, Jasmine and Drew on the production side. Thanks for tuning in. We'll see you next week.